Evening, ladies and gents. Simon Brown here, doing the intro for this evening's webcast. We've got Gary Boyson from Rand Swiss. Always a treat to have him online. And we're talking in particular commodities. Is it too late to buy the commodity boom? And this was my remit to Gary probably 6 or so weeks ago. So data has changed. But if there's anyone out there who's got a sense of what's going to happen to our petrol price, but more widely than that, it's going to be Gary. We've got time for Q&A. Drop your questions into the question box on the GoToWebinar app. We'll take those at the end of the presentation. And we are, as always, recording. We'll get it up onto the YouTube channel. It'll be on the Just One Lap Rand Swiss websites, probably sometime late tomorrow afternoon. But Gary, with that, over to you.
Okay, thanks, Simon. Thanks for the intro. So yeah, the mandate I was given is it too late to buy the commodity boom? So we're going to kind of investigate commodity markets today. Yeah, just to run you through what we'll talk about. I'm just going to start pretty simply about investing in commodities. What are commodities? Why do you want to invest in them, etc. Pull that across. Yeah, so then we'll just look at kind of how do you actually invest in commodities. So some a little bit of the practical mechanics around investing in commodities and the different ways that you can get exposure. We'll have a look at general commodity markets today and what's going on, and then obviously try and answer that question: is it too late to get involved? And that's where I'll have to make some calls right at the end, so that you have to stay on for the hour. Yeah, it is obviously, I mean, the rides have been spectacular, but first of all, before we get started, why should you listen to us? First of all, I'm not a geologist. I'm not a professional commodity arbitrage trader. I'm just a humble portfolio manager. We have to kind of take commodities as inputs into our calls, but what do we do? I obviously am one of the directors at Rand Swiss, along with Viv Govender, and we run a diversified financial services firm, which means we link a whole lot of different people together. We do everything from online trading, private broking, managed portfolios, all under our stockbroking business. We've launched structured products. We do offshore transfers. We've obviously got Yaku as the certified financial planner. We've got some wealth business as well, and tax-free savings accounts. So that's kind of like our business. And obviously commodities, like especially to the managed portfolios, which I run, and obviously we've got a lot of our private broking clients that will ask us these questions all the time, because commodity prices are just so important to understand where and how to invest. It's an input to so many different aspects of financial markets. How did we rank? How do we do? Why should you listen to us? Currently, we are ranked the #1 securities broker in South Africa, which is I'm incredibly happy with, and that's why I put it on every presentation that I can, mainly because we beat some of the big banks, and most of the other stockbrokers we competed at are massive listed companies, and we're a much smaller firm. So I'm really happy with that we are currently ranked number one. We didn't just rank as #1. We've also got a whole lot of other kind of awards as well. So top tax-free savings provider in South Africa 2 years in a row. So if you want that kind of stuff, come chat to us. People's Choice Award voted by our clients. So the guys that are listening to our calls and chatting to us do seem to like us, which is obviously a good thing. And then obviously that overall award as well. So hopefully that builds a little bit of credibility, even though I'm not a geologist or even a farmer. So it gives you hopefully a little bit of credibility to listen to me when I talk about commodities. So let's start with really the basics. And I just want to go through investing in commodities, like 101. What is a commodity? How does a commodity differ from stocks and bonds and all of that? And really the most basic definition that you can get of a commodity is an economic good, usually a resource that has full or substantial fungibility. Now, that probably doesn't explain much if you don't know what fungible means. Anyone that's kind of dabbled in the crypto markets will probably have an idea as to what fungibility means. But essentially, fungibility is individual units are essentially interchangeable. So when most people think about commodities, they're probably thinking about raw materials or basic resources. So if you have actually done Economics 101, you'll probably have heard of something called the factors of production, of which resources are one. Any good and service, usually relies on resources and input. And that's what we're talking about when we talk about commodity markets. Now, commodity markets can be those kind of very basic commodities, but they can be things as complex as semiconductors, anything that almost becomes fungible. It's a process called commoditization. Once something is commoditized, you have almost this interchangeable unit, and there's no kind of brand differentiation. It's just a stock standard product that has almost a, I want to say like an international ruling price, but obviously, big bulk commodities, their prices are slightly different because of transport costs. But essentially, one unit of this is the same as another unit, and that you can't tell the difference. So I thought I'll chuck in a Karl Marx quote for you as well. So Karl Marx, obviously he said, from the taste of wheat, it is not possible to tell who produced it, a Russian serf, a French peasant, or an English capitalist. Now, that really is why wheat is a commodity, because you cannot tell one wheat from another, basically. So inside the commodity market, there's a couple of different definitions that are probably quite important to understand. When we talk about commodities, we're not just talking about, what a lot of people think of commodities. I don't know what you guys think of commodities. So a lot of people think gold is a commodity, iron ore, metals, tin, that kind of thing. But commodities are broadly divided into hard commodities and soft commodities. So what is the difference between a hard commodity and a soft commodity? A hard commodity is generally mined, a soft commodity is grown. You can normally eat a soft commodity and you shouldn't be eating hard commodities. So platinum, rhodium, palladium, iron ore, oil. Now you can further subdivide this into the energy complex. You can subdivide it into grains and oil seeds and all sorts of different things. But those are the big kind of definitions of commodity pricing, or at least how you would split commodities at least. So why do people want to invest in commodities? Why is everyone on this call decided to attend and learn about investing in commodities? Now, there's a couple of different reasons. And first of all, I think you've got to remember that the commodity markets are actually a lot older than stock markets or bond markets. Commodity markets go way back to kind of silk and spices, and long before there was such a thing as a bond or a piece of paper or a share in a company, commodities were traded. And I think it's because of this very primary and basic nature of commodities that they attract retail investors specifically. People like the idea of commodities, especially if someone has no idea about investments in the investment world, they're automatically almost drawn to the commodity side of it because it's something physical that you can understand. A share can be quite abstract. In that you deserve a portion of profits of a company. A bond, where you basically lending someone money and they're going to pay you back a coupon, that can be tricky for a new investor to understand. Whereas a commodity is easy. Oh, I get a lump of gold, and gold can go up or down, and that's how I'm going to make a return. So that's I think it's the simplicity, the perceived, and I put the perception there, the perceived simplicity, that they are easily understood. Which is maybe not always the case, and then also because of, in a way, because of the volatility as well. So, as we've seen in kind of crypto markets, very volatile markets, or markets that move, dramatically and have speculators in the market, they tend to do well in retail markets specifically because there's something that people chat about around the braai. Oh, I bought some silver contracts, or I've got a gold coin. Have you seen what's going on with this? Or look at what's happening in coal prices. I managed to get some coal contracts, or I bought an oil ETF, or whatever the case is. And there's, because of this huge volatility, there's kind of those very short-term, very aggressive swings that will far outperform, like a standard money market product, or even just a normal equity portfolio, because the volatility is just so high. What does that mean? It means like there's this FOMO, the word gets around, and word of mouth, everyone suddenly wants to get involved, even though they maybe don't have the necessary understanding. So those big swings up tend to attract retail investors, and it's why I think people are, the average man on the street actually often starts their investment journey in the commodity markets rather than in kind of the formal stock markets or in a bond market. But that's not to say that professional advisors and professional traders don't use commodities in all sorts of different ways. So I've kind of split the two, and I'm trying to make the distinction here. So why do professional advisors use commodities in portfolios? Now, probably one of the most important reasons to use commodities when building out, if you're an independent financial advisor, is you want to add commodities to a client's portfolio because you're looking for a non-correlated return. And by getting a non-correlated return into a client's portfolio, what you're doing is you're actually dropping the level of risk. So if you've got a client that's got 30 or 40% in equity, they've got 20% in bonds, and you're looking for a way to kind of flesh out the rest of the portfolio, commodities suddenly become very attractive because they behave differently to standard equity markets and bond markets. They often, there's like either lead lag relationship, but different commodities can have very, very non-correlated returns. So as an extension of that, not just looking for non-correlated returns, it also gives you a powerful diversification, because it's not just that they're a negative correlation. It's not just that buying gold in a portfolio, for example, where if markets are falling, you expect it to go the other way. It's that some commodities are just not correlated to markets at all. Markets could be going up, they could be going up. Markets could be falling, they could still be going up. You just don't know, and it's that kind of non-correlated nature that you're looking for. But the ultimate intention of a financial advisor would be to diversify a client's portfolio. Now, obviously very topical at the moment, the other huge benefit of commodities is that they act as hedges against inflation. So often buying physical stuff. So what is inflation? Inflation is the general price rise. It's the general lifting of prices in an economy. And one way to protect yourself from rising prices is to hold physical, whether you hold it physical or via an ETF, but is to hold those hard commodities or the physical goods, because as they inflate, your portfolio is protected against inflation. Now, obviously that's become very, very topical with the high inflation that we've been experiencing, and we've been seeing commodity markets running on the back of that, which is one of the reasons that we've seen such exciting gains. But that inflation hedge component to commodities is also an important aspect for professional investors to use commodity or commodity-linked either companies or ETFs, etc., to add to portfolios, to try and generate that alpha, to try and put their client in a position or try and achieve a financial goal. Finally, the volatility, obviously I've said that the markets are quite volatile, can create opportunities for very clever, and I've said it, very clever traders. So if you're very, very good at kind of playing that specific commodity market, you can do very well, because there are often misprices, depending on the physical market that you're looking at, but different markets can be quite different. And of course, there are lots of fun for speculators as well. So speculators also, because of the volatility, will have a lot of fun. But generally, you do need to be very clever. And I'm going to kind of extend that idea a little bit further. So before we kind of look at the different ways to invest in commodities, the last thing I want to look at is what is the dangers of investing or trading commodities. So the first is that generally commodity markets, and it's obviously not true of every commodity market, because some commodity markets can be localized. If you've got something that's very expensive to transport, even oil to an extent. I mean, you guys all, I'm hoping, know that there's a whole lot of different oil contracts in the world. You get Brent crude oil, and you get West Texas Intermediate, and there's all these different oil contracts, because oil actually has different prices depending on where it is in the globe. So you do get the localization aspect of it, but generally to be commoditized, to have something that is become a commodity, they generally are very, very large markets, very large and generally very efficient. So you've got a lot of participants looking at this price all the time, measuring the supply-demand dynamics, trying to balance things, and all making predictions. What happens then is markets tend to become very, very efficient. So then it becomes very difficult in an efficient market for you to kind of generate alpha, if you want to put it that way. It's very difficult for you to go and find, certainly as a retail investor, like the angle to say, oh, wheat is too cheap now, it's got to go up, or oil, because the market is just so efficient. There's so many very intelligent actors acting in the market. Of course, the other aspect of the danger of investing in commodities is that they are volatile. And if you consider volatility at least as risk, then they are naturally higher risk. If you're a financial advisor sitting with your clients and you're trying to work out how much they're going to need in 5 years or 10 years or 20 years time at retirement, and you've got this component in your different baskets that you're building, and that component, you're not sure if it's going to do 50% or if it's going to do, if it's going to lose 20%, that makes your job a lot more difficult, because there's a lot of uncertainty. That kind of leads us to the next one, which is from an analytic point of view. So if you are dealing with a very liquid market, a very volatile market, it really increases forecasting risk. So even if you're an analyst working for a mining firm and you're trying to price underlying iron ore prices, you have a high degree of forecasting risk. If you're an analyst that's covering a mining company and you're trying to put price targets in place, the price of their good could be anywhere, and it's very difficult. I mean, you look at the supply-demand dynamics in platinum, for example. You go look at like the Johnson Matthey reports. You kind of get a sense of like, is the market in surplus or is it in deficit? But the point is, the forecasting risk is very, very high. So that makes it, again, very difficult for you to effectively predict things in commodity markets, and that adds to the danger, if you want to put it that way. And then finally, again, it depends how you get access to the markets, and I'm going to look at that in the next couple of slides. But if you aren't going via the physical underlying commodity, so if you're not buying a block of gold, or you're not going and buying some frozen orange juice concentrate, or you're not going and investing directly in the wheat price or in silver or whatever the underlying commodity is, and instead you're investing in the producer, you are often, the producers are mainly price takers. So there's very, OPEC is kind of one of the very few kind of cartel structures that actually has a significant influence over something like the oil price. But most commodity companies are price takers. They're just, if the price of their commodity is going up, if you're a farmer and you're planting wheat and there happens to be war in Ukraine and the wheat price happens to spike, well, guess what? You're going to have this windfall profit, but it was totally outside of your control. So the producers have to kind of focus on what's inside their control, and because they're price takers, the actual end product is outside their control. Very different from Apple, for example. They can say, wait, an iPhone, that costs X amount, that's how much we're going to go to the market with. To an extent, they can control the price of their good, especially the stronger the brand a product has, the more control they have over the ultimate price. Just the nature of commoditization takes away the control over price. But they've also got all the operational risks as well. So if you're a mining company, you can have labor unrest, strikes can shut down your mine, you can have dam walls collapse that take out your production, and then you can have your partners sue you. There's a lot that can go wrong. There's a lot that can go wrong from an operational point of view. Mining specifically is a very difficult, very, very highly technical endeavor. Of course, you've also got all the issues around regulation as well, especially if you're extracting primary minerals from an area. In South Africa, we even have challenges around property rights. So, even if you're a farmer, there's kind of risks around what is your actual property worth. So there's all those kind of operational risks that come with owning the underlying provider. Now, that is translatable to most other businesses. It's a business risk, but that risk is definitely different from the risk of just owning physical underlying. So it's important to, I think, make that distinction. That gives you kind of like a basic overview of what commodities do, how they work, maybe a few ideas to think about before you suddenly decide to become a heavy commodity investor. So the next thing I want to look at is okay, first, how do you actually invest in commodities? What are the different ways you can invest in commodities? And then also, should you be buying the underlying mineral or good, or should you be buying the producer and facing all of those risks that I've just mentioned? So if we look at the how to invest in commodities, okay, like what are the basic areas? I'd say there's 4 that I've identified. So if the commodity that you're talking about is very dense, so very small and it's quite dense, and it's got a high value to weight ratio, if you want to put it that way, and it's not dangerous, then you can invest in the physical. So buying something like a gold coin, very, very easy. Investing in physical gold, it makes perfect sense, because you can literally go on with your screen with your stockbroker, and you can put the ticker as KR, and you can go and pull up a Krugerrand, and you can go and hit you can go lift the offer on a Krugerrand, and the next thing on a Tuesday, your Krugerrand will arrive, and you can go collect it and put it in your pocket or put it in the safe. It's very easy for you to store that commodity. If you want to call gold a commodity, it is, I suppose, technically a commodity because it's mined. People call it a currency as well, but yeah, that's very simple. It's very different. Even if you translated that to something like silver, silver's trading, I think it's at $21 an ounce at the moment. It's you're gonna, if you want to make a meaningful investment in silver, you might be talking about having to get a warehouse to house all that silver. It's very different when you're trading at just under $2,000 an ounce or $21 an ounce. You start getting proper physical bulk in the commodity that you're buying. The same with something like iron ore. To go and physically buy iron ore as a retail investor, I mean, you're going to have huge yards to pile up your iron ore, your coal. It's not practical to invest in physical in that situation. The same with something like uranium. You can't invest in uranium. You can't just go and buy a little bit of yellow cake and stick it in your fridge. It doesn't work that way. You're not going to actually have access to those physical markets. So you've got to kind of also look at the commodity that you're trying to target and see whether holding the physical is actually something that can be relevant to you. There's a wonderful article on Bloomberg years ago about, it was one of the journalists tried to buy and invest in a physical barrel of oil. And these things are like, a barrel of oil is actually highly toxic, and she ended up putting it in a bath, and like they had to have hazmat suits. It was like a total disaster. It's a wonderful article from, I think it was about 2011. But yeah, physical only works in very, very specific situations. How do we solve the problem of physical? That's where ETFs and ETNs come in. So what is an ETF and an ETN? An exchange traded fund or an exchange traded note. And this is basically paper. So it's paper that is issued, proxy paper, and you can avoid a lot of the physical problems with it. So one of the first ETFs, which is an exchange traded fund that was issued in South Africa, was the New Gold ETF, which gave you basically the promise of 1/100th of an ounce of gold that used to sit in the Rand refinery. I think it still sits in the Rand refinery, and you have a claim on that underlying gold. Now, the difference between an ETF and an ETN is an ETF, you have claim on that physical underlying. So the Absa New Gold ETF almost became what the dollar was when there was still the gold standard. It was a little piece of paper or a little digital contract or a digital note like they are today that said you actually own a little piece of gold sitting in a refinery. And for that, you would pay a management fee. I think their management fee at that stage was about 1% when they first started out. It has come down quite a bit since then. But essentially that management fee covered the physical storage of your gold, and it covered basically the setup of the ETF, etc. And it ended up working out a lot better for people than holding physical Krugerrands, because they didn't have the risk of having them stolen. They didn't have to pay insurance, or they didn't have to pay for a safety deposit box, and they didn't run that kind of risk. So what's the difference between an ETF and an ETN? An ETN is an exchange traded note. An exchange traded note is basically, it's a promise from a banking institution saying that we will track the price of this underlying, but you don't actually have a claim on that physical underlying the same way as the ETF. So you basically have to be happy with that bank's credit risk. So if you're buying a Standard Bank linker or a Standard Bank ETN, you've got to be comfortable that Standard Bank is going to be okay, and that they're promising to pay you, let's say, the silver price. Now that's an ETN. The other way to invest in commodities is to actually go and buy the producer, to buy the business, the miner or the farmer. So you can, I'm talking about going and buying something like Glencore, Anglo American, or Tungela Resources. Here you face all the operational challenges of the business, but you also benefit in other ways. And that's one, you have an experienced management team that is trying to produce at the right pace. They're trying to make sure that their cost of production is below the cost of their ultimate commodity, and that they're going to generate profits, and those profits are going to be paid over to you as a shareholder. Now, I'll talk about the difference between this in a second. Farming the same, you can go and look at kind of direct linked, agri businesses. But the other way to do it is the supplier, and it's the idea of you don't want to go and buy, let's say, a gold miner. You might want to go and buy someone who sells shovels to gold miners. And it's trying to pick up some of the downstream benefits. So you can buy suppliers into the primary sector, and often if you get a big spike up in commodity prices, those kind of direct suppliers will benefit. So you think fertilizer providers, for farming specifically, you're talking like fertilizer, equipment, mining is like big yellow machines, something like Barloworld would do well. And that's a different way to capture a commodity price. And then finally, the trader. So the trader can also go in there, and like I said, like if you're very savvy, and I mean, if you are a farmer and you kind of have a very good idea of what's happening in the weather, and you've got your crop photos, and you kind of know what's happening with El Nino and El Nina, and you've got a good sense of where this underlying market has been, because farming is in your blood, and you've been farming wheat for the last 150 years, and your family has had this farm for generations, and you're very, very close to the underlying commodity, then you can probably have a much more reasonable chance of trading it. As a novice investor, just deciding that you're going to go and do some technicals on wheat, it's probably not going to end well for you. But you can also pay professionals to do this for you, and it's one of the ideas I'll chat about a bit later in the presentation. But you can look at something like a commodity arbitrage hedge fund, which are professional traders. They have all that expertise, and you can just leverage off their expertise to benefit from mispricings in commodity markets. Now, a question that I get asked kind of over and over again, it happens on the business channels regularly. It's just something that always comes out whenever there's a big commodity price move. They say, would you buy the underlying, or would you buy the business? Should you be buying the miner, or should you be buying gold? Should you be buying Kumba, or should you be buying iron ore? So the way that I've kind of started to think about it these days is that there's a big difference in how the value of a miner and a commodity is generated. The value of any commodity is generated purely through scarcity. That is where the supply-demand dynamic in that underlying market, if there's an oversupply and there isn't the demand to match it, the prices will fall. Another way, if there's a high demand and not enough supply, the prices will rise. And that is what's generating the returns, if you want to put it in commodity markets. Now, that's very different from a formal investment instrument or something like an equity or a bond, which is essentially part of the capital structure of a business or a commodity producer. Because what happens when you buy a share? What does a share mean versus buying a lump of gold? What does a share in a gold miner give you? A share in a gold miner gives you a call on the profit of that gold miner. It's saying that when that gold miner makes profit, you are due a portion of those earnings that can be paid out as dividends, or it could be paid out via share buybacks and to help the stock price appreciate. You might be taking it as capital appreciation, but essentially you have a claim on those underlying earnings. Now, what do you get for that when you buy a stock? You get like I said, you get a management team that is probably top engineers and top commodity miners. You're adding value to an ore body because there's this whole management team that is mining that ore body, and you get to benefit from all of that as a shareholder. The same as if you're a bondholder of a mining company. What have you done? You've said, I've looked at the risk that this business is going to go under, and I've said I will lend them X amount of money, but in return for that, they're going to give me my capital back, plus they're going to give me my coupon. So that you're taking your money and they are promising to pay you more than your money back. Now, with that, over a long period of time, both of those kind of stocks and bonds, which are the more traditional, which are not alternative assets, as a commodity would be, they will compound over time, because you'll invest and you'll get your coupon, and the coupon you can reinvest, and you'll be able to compound that return. Whereas holding a commodity long term, you're only really benefiting from the inflation. You're benefiting from the devaluation of a currency that is propping up the price of that commodity in the long term. And otherwise, it's just supply-demand dynamics kind of shifting the relative scarcity of your underlying commodities. So if it actually came to me, like if I was a long-term investor and I was looking at, for the long term, saying, I want to get involved in commodities and I want to be there for a long time, I would say you definitely go with a business rather than just rely on scarcity, because scarcity changes very, very quickly. If you're a trader, of course, you're trying to see that price action and you're trying to benefit from it. So that's kind of my view. At the moment, I'm kind of tending to lean towards like a more formal investment vehicle, but it really depends on what you're trying to achieve. If you're taking a 6-month view, then you probably wouldn't buy the miner or the farmer. The beauty of kind of buying the business as well is that if your call is correct, so let's say that a gold miner has an all-in sustaining cost of $1,100 an ounce, and suddenly your gold price is sitting at $1,800 an ounce, you've got this, like it's basically in accounting, it's called operating leverage. They have these fixed costs, they've sunk their shafts, they've got their labor, and their labor is paid, and they might have had to do a couple of above inflation increases, but their labor is working on the mine. All their big yellow machines are there. They've got a cost of capital. They've got a business, right? And their costs are coming out at $1,100. If the gold price suddenly just starts to run, it doesn't add anything to their cost base. Their product is just a lot more in demand. And what happens is all of that additional revenue that's generated as the price appreciates just drops straight to the bottom line. So often what you end up getting in the commodity miners, especially in a bull run for commodity markets, is you get these huge chunky dividends, because either the guys can't sink shafts fast enough, and they can't, building a mine, for example, is a long-term project. Farmers can't suddenly double the size of their farms and suddenly produce 3 times as much crops as they used to be able to. So supply kind of stays there, and you just get these kind of like big bumper windfall profits. So my preference is at the moment to go into the underlying business rather than but qualified as it really depends on what you're trying to achieve. If you're speculating in the short term, then it's a lot cheaper and probably a lot you could probably maybe do a lot better on underlying contracts. So what are the popular ways to invest in commodities? Like if you're looking at the direct commodities, so exchange traded funds of the 88 listed ETFs on our exchange, as is listed on the JSE website at the moment, 8 of those are commodity-based ETFs, and you can see it's very much focused on the platinum, palladium, rhodium, gold. Half of almost half, well, exactly half of them are done by One Invest. And of course, you've got GLD, which is the absolute gold ETF that I was talking about, which gives you access to gold, but very, very limited in terms of what you can actually do. But any of these ETFs will give you a physical claim on those underlying instruments. When it comes to looking at something like ETF Rho, which is rhodium, just remember that the rhodium market is not nearly as liquid. So the physical rhodium market is nowhere near as liquid as something like the gold market. Gold, you've got an international gold price. Rhodium, that price is actually settled in the physical market. So I would say go and look at the pricing and how these ETFs work, but that's pretty much what's available to you on the local exchange. Of course, you've got a whole lot of ETNs as well, so you can go and express a view on things like oil and copper through some exchange traded notes as well. Now that's kind of your JSE listed options. Of course, you can also go and look at kind of the agri markets where you can go and trade, or like SAFEX, for example. You can go and trade futures on underlying agri prices as well. And of course, when it comes to actual listed companies on our exchange, the list is long. We are very much a commodity-based exchange. So compared to someone who's sitting in other countries, if you're living in Italy and you're looking at, or you're sitting in Germany looking at Deutsche Börse, South African investors are absolutely spoiled for choice when it comes to mining companies, which is, I suppose, my preferred way of getting involved in the market. I mean, you've got the big diversifieds. You've got the likes of Anglo and BHP Group. You've got African Rainbow Minerals. You've got a commodity trading, well at least it's a big diversified, but also a commodity trading firm like Glencore. You've got two amazing coal producers in Exxaro and Tungela. Tungela obviously spun out of Anglo American as they try and get their ESG profile right. Gold miners, you've got Anglo Gold, DRD Gold, Goldfields, Harmony, I mean, PanAf, Platinum, you've got Amplats, Implats, Northern, RB Plats. I mean, the amount of commodity companies listed on our exchanges is absolutely massive. If you're looking at softs, we've got things like Carp Agri, you've got some fertilizer companies, you've got things like Zierde as well. So there are a lot of options for investors looking to take advantage of either soft commodities or hard commodities in the South African exchange. That said, if you do look a little bit wider, and you start looking at kind of international investment as well, and you're prepared to use your offshore allowances, the world really opens up. What a retail investor can do these days in the commodity markets is nothing short of spectacular. So I've just put a couple of the contracts up, and this is by no means exhaustive on our offshore platform that we give to retail clients. I mean, you can trade literally, like just putting it up here, I'll just list them. So I've just put the kind of the big commodity miners and kind of soft access at the top. So things like Vale, BP, so BP, Royal Dutch Shell, Rio Tinto, ExxonMobil, all of these, listed in, across, everywhere from Europe to the US to London. You can get access to that. You can get access to things like Nutrion and DuPont and Bayer if you're looking at inputs into the agri sector, things like Deere & Co. You're looking at tractors. Then of course you can go and trade, physical gold, physical silver. You can trade platinum. You can trade, I've put the Sprott uranium miners ETF in there. You can really get access directly to uranium miners. You can trade corn, sugar, wheat, orange juice, copper. It's kind of like what you want. And as I said, you can trade a whole lot of different types of oil depending on what your view is. Everything from Brent crude oil to West Texas to light sweet. There is a lot of options out there for retail investors. So you're not limited, is what I'm saying. You're certainly not limited in how you can express a view. But where are commodity markets today? And I think that's kind of key now, because what I've got to try and answer for you tonight is, where do you actually deploy capital if you're looking to take advantage of commodity markets, and what is the situation on the ground? So let's look at that for a second. Okay, so first of all, there's no question. I mean, anyone that's been in financial markets recently will know that it's scary out there. It is very, I mean, this is the CNN Fear and Greed Index, and I'm just going to paint a quick backdrop of where we're at. The market right now is in trouble. People are very, very nervous. We've had big drawdowns. I mean, the S&P 500 is in a bear market. South Africa has fared a lot better because of its high commodity exposure. So we're only down around 10% at the moment. But I mean, this is all coming because there's a lot of fear at the moment that that we are going to go into recession. OPEC has announced, price output increases. That's a little bit suspect as well, because OPEC announced big output increases, but then they kind of like changed the way that their quota system worked and said, Libya, you can produce a lot more. Russia, you're fine, you can produce as much as you want. And these were countries that actually couldn't produce their quotas anyway. So there was kind of a little bit of a misnomer in the oil markets. And now what's happened is, obviously, with the Fed kind of hiking interest rates, which I'm going to look at in the next slide, we've had, we're looking at the potential of a hard landing. We're looking at the potential of demand actually sapping out of the economy, out of global economies. So we've seen the oil price coming down in the last couple of days because of that. People are really afraid that we're going to go into very recessionary conditions. Even Elon Musk has the super bad feeling about the economy at the moment. In an economy that is not growing, commodity prices will fall. So we need to put that in perspective. Headlines from today in the Financial Times: iron ore price surrenders gains for the year as Chinese demand cools. So we're getting the sense that the picture out there is very, very tough. Crude oil buckles as recession angst rattles commodity investors. So this big run up that we've seen in commodities is starting to unwind a little bit as people get really concerned about the growth picture. So just looking at, I'm just going to look at the US economy very, very quickly. Just to give you a sense of kind of where we're at in the cycle, and I've got a nice commodity clock for you at the end, where we're going to kind of try and put where we are, what time we're at. But what's happened in US inflation, we've gone into a very inflationary period over the last, let's say call it the last year. 2 prints ago, when we got that 8.3% print, I think everyone just breathed a sigh of relief, and there was this hope in markets that maybe things are getting better, maybe inflation is going to moderate, and maybe we're not going to have this hard landing, and maybe the Fed isn't going to have to increase interest rates quite as aggressively. And markets started to rally. We had equity markets starting to rise again, and I think commodity markets subsided a little bit. And then we got last month's print, and it was just like, oops, this isn't over yet. We're pretty much getting the worst US inflation figures that we've had ever. So inflation is in the system big time. That should technically be good for commodity markets, because remember, commodities do act as an inflation hedge. Now, the problem is that we've already seen a response, and just remember this when we're talking about the commodity clock in the next couple of slides. The Fed is responding very, very aggressively. Look at the, how the Fed, very gradually hiked rates, from 2016 onwards. Your guys might even go further back and remember the taper tantrum before that. It was like the Fed was, very slowly, very gently easing the market into the idea of higher interest rates. What's happened now is the Fed is almost panicking. I mean, in our research meeting this morning, we do research every Thursday. I mean, we're also looking at what's going on in the bank in Japan. Fascinating things happening in the Japanese bond markets at the moment. But we have the Fed really just putting pedal to the metal here, and you can see how fast, with that 75 basis points of the 0.75% hike, you can see how fast interest rates are going up in the US at the moment. How does the Fed control inflation with interest rates? They stall the economy. That is what they're trying to do. Stalling the economy is not a byproduct of increasing interest rates. It's the point of increasing interest rates. They're trying to stop the economy from growing. That is what they're trying to do. They're saying the economy is too hot and it's starting to result in inflation. When the Fed does that, they kill demand. When demand gets killed, commodity prices fall. So just bear that in mind. That's the situation that we're sitting in from an economic point of view. Unemployment 3.6 for a long time. People considered below 4% impossible. They didn't see below 4%. In any economy, there's what's called the frictional rate of inflation, and frictional inflation, that's the kind of the level of unemployment, frictional unemployment. That's the level of unemployment in an economy that is supposed to be there. It's people that have resigned and are naturally looking for other jobs because they're changing careers, essentially. People didn't believe that you could get unemployment below 3.6%. They considered that below frictional. Now, what's happened is that's just another sign that the labor market in the US is very, very hot, that the Fed is going to kill. They are going to have to kill growth. They're going to basically try and create a recession in the US. Now, remember, from a stock market point of view, that means that everything goes down. Now, fortunately, stock markets are forward-looking. So what's happened here is, you can see this is a picture. This is a year-to-date heat map of the S&P 500. There's a year-to-date kind of heat map of the whole world. You can see where the patches of the bright spots have been. Part of it has been the oil and gas market. Part of it has been the energy markets. Things like ExxonMobil, up 43% year to date. So that's the oil and gas companies really running. They are already responding to this high inflation. Commodity prices have already run. You've got a little bit of like a safe haven in the healthcare sector. You can see that here with things like, okay, so Royal Dutch Shell up 17%, AstraZeneca up 10%. That's really been the only kind of hiding place. Like locally, you've got Sasol, they're using the US ticker there. That's actually Sol on our market. But you can kind of see this is a petroleum company as well. So it's really been oil and gas. It's been the only green spots in equity markets recently. So yeah, I think just be careful when you consider that markets and equity markets specifically are very forward-looking. So while a recession is probably going to happen, it's our view that we are going to get a recession in the US. The stock market has in a way already reacted, and the recession that's coming is what the stock market is currently predicting. So let's look at now some of the commodity price moves over time as well, and got kind of a couple of different charts that I'm going to run through quickly with you. I want to leave some time for questions as well, but Refinitiv, this is basically the Bloomberg Commodity Index and the Refinitiv Commodity Index. You can see what's happened since 2020 lows. Commodities have absolutely gone berserk. Now, the green is the S&P 500. You can see that stock markets have started coming down this year as commodity prices keep running, but commodity prices have been running hard. I just want to take you out a little bit further. Now, this goes back to the idea of, should you be investing in the physical commodity, or should you be investing in a stock, or should you be investing in the miner or just the market in general, and maybe avoiding commodities? This is the return of the S&P 500 in green versus, again, the Bloomberg Commodity Index and the Refinitiv Core Commodity Index in orange. You can see that even after this big run up, so that kind of period there is the period that I showed on the previous slide. So let me show you, it's that period there, over there. That period is still not taking us up to kind of the high levels of 2008. So, you know, you add inflation into the mix now as well. There is the potential for this to go a lot higher. So is it time to turf commodities totally and get out? You know, just looking at historic price action, there could be a lot more run. There's certainly momentum behind this commodity run up. Long term though, equities are going to outperform a direct investment in commodities. Just, you know, just keep that in the back of your mind. And that's what I wanted to show you on that slide. So what's happening in the oil markets? I've already talked a little bit about oil markets. So this is just a year-to-date chart. You can see what's happening with oil at the moment. So these are some different types of oil and kind of almost energy market stuff. LCOC1, which is the green one, is up. Okay, when I pulled this chart was pulled a week or two ago, up about 100%. So I mean, you've almost had a doubling in the Brent crude oil price. Now, is this the top? If you look at kind of a lot of sell-side research, you listen to someone like Goldman Sachs, you know, a lot of the big banks, you know, have said once you adjust for inflation. I mean, if anyone remembers the $144 a barrel oil, I think that's the time that SAA decided that they had to hedge oil as well. They said we can't afford to go any higher, and that was pretty much the peak of where the oil markets were. If you then adjust this for inflation, you know, we're probably sitting at about $180, $190 a barrel to get back to if we're in that situation again. The problem is, like, my view is that the Fed has already started trying to kind of curtail the growth, and I think there is going to be real demand concerns in the market. It's one of the reasons that we saw oil pulling back from $120 a barrel this week. Also, you've got to understand that, you know, economies are very, very efficient, and how can I say, oil companies or companies or, you know, economies, people are very innovative in reacting to supply shocks. So why has oil gone berserk? Okay, part of oil, and we've had inflation, and part of the reason that oil has gone berserk is because we've had COVID and supply shocks, and there honestly has just been an underinvestment in the sector. When we bought ExxonMobil years ago, when oil was trading negative, and we were adding things like ExxonMobil to portfolios, you know, we were listening to the executive at that stage and looking at the energy reports, and it was people were saying, like, we still use oil. There's no physical way that the world is going to wean itself off oil. There's going to be a supply shortage. And it was just because we had green energy coming in, and no one wanted a dirty oil and gas player, and the performance had been terrible because OPEC had been, you know, almost flooding the market. I mean, I don't know if you remember when Russia and Saudi Arabia got into a bit of a spat, and they just decided they were going to flood the market with oil at that stage. It was kind of as coronavirus was really picking up, demand disappeared and supply went berserk, and that's when oil traded negative. That was a great time to be buying oil. Should you be buying oil now? yes, Ukraine has had a big effect on the energy markets, but if you look at import numbers from China, the May import numbers, you can see that Russia has actually displaced Saudi Arabia as the biggest supplier of oil to China. There was like a 55% spike in oil bought from Russia, China buying oil from Russia. So what you're seeing is you are seeing the markets adapt. For example, Russia is now selling wheat to Bangladesh. So while you have European sanctions on Russian oil is not suddenly just not being sold. And whereas, let's say Germany might have bought Russian oil in the past, they might buy it from Saudi Arabia, but China is just, the patterns of trade are just changing. And I get the sense that, the idea of us going to $200 a barrel, I don't think that that's happening. I think we are at the upper side, just my view. Again, super efficient markets, a lot of market participants. I'm just a portfolio manager, I'm not an oil analyst, so this is kind of my sense of where oil is and how I would be deploying capital. Looking at this, so this is just a chart of the power complex. Specifically, you can see that the big spike up and down, that's NGL NMC1, which is ICE. Okay, so it's European Intercontinental Exchange. So that's UK natural gas, and you can just see. I mean, if you've read any headlines recently, you'll know what's happening in the energy markets in Europe. I mean, prices up significantly. Again, what is this going to do? This is taking money out of consumers' pockets. It's going to dampen demand. And there's the saying that inflation is inflation's best cure as well. So we are going to go through a period of slower markets. Now, for me, is this priced into equity markets? I think equity markets are starting to price it in. I don't think it's yet priced into commodity markets. I think prices could start to fall in commodity markets. So I just want to look at the soft market for a second. So these are a whole lot of different soft contracts. KCC2 is ICE US coffee futures. It's not iced coffee futures. You're not drinking like cold coffee. Again, Intercontinental Exchange coffee futures. All of these just giving you kind of a sense of what is happening with the price of softs. And you can see the price is up heavily. We are seeing a big run up. Food prices are going to inflate. Food prices are going to be an issue. I mean, we're talking about massive runs up in these commodity prices. And yes, markets can adjust to an extent. But like where I think oil and gas and energy markets might be topping out a little bit. Like in our research meeting this morning, our guys were very bullish on coal, not so much on oil. So they prefer coal to oil, for example. There's no question that we are facing much higher soft commodity prices, which is going to fuel inflation. But would you go in and buy direct contracts? I personally probably wouldn't, unless you're a trader. Certainly not as a long-term investment. Here's some wheat, corn, milling wheat, and a whole lot of different grains and oil seeds. You can see also, I mean, you're talking up, above 100%, between 100 and 200% for the year. I mean, commodity prices are a lot higher. Soft commodity prices are a lot higher than they have been previously. I've given you a nice long-term chart going back to kind of like 2002, and I just want to show you like the kind of increases that we've seen. I mean, we're talking about significantly higher than we were kind of 2008, 2011. These are big moves, very, very big moves. So now I've got to decide for you guys, is it too late to get involved, which was the mandate that Simon gave me. So I've kind of put this up. Okay, one of the most traded commodities. Now remember, the reason I've got that up, those are, according to the Futures Industry Association, the most traded commodities in the world. But just take it that every commodity is unique. So the commodities that we're probably constructive on are things like coal, things like lithium. Platinum, we think is going to be sideways, probably down. We don't see a huge run up in platinum. Oil, like I said, oil, very difficult to read in all of this. I mean, you've got to take with a pinch of salt, because they are such efficient markets. But yeah, I'd say oil demand, I think I wouldn't be hoping for another 100% up if you're buying oil at this stage. So where are we in what I call the commodity clock at the moment? Now, like our view is we're probably between 1:30 and 2:30, not quite at 3 o'clock yet, but we're getting towards 3 o'clock, where we're going to start to see falling commodity prices. We've seen overseas, okay, locally we have our own challenges around real estate, but if you look at real estate values overseas, they have been flying. Interest rates rising interest rates. There's no question that the interest rate cycle has started. We are starting to see rising interest rates. Have we seen falling share prices? Yes. Stock markets are down. Have commodity prices started to fall? I get the sense that commodity prices are now starting to fall. We're not quite at recession, but I mean, again, if I go quickly back to that US slide, remember, a recession is 2 quarters of negative growth. We've had 1 quarter of negative growth in the US already. So we're getting quite close to a recession. That moves us into recession. Money is a lot tighter. Economies contract. Real estate values start to fall, which I think is next. You've got, this is the dark night before the recovery starts. And I think commodity prices probably have some downside in general. So I would be concerned. I think you've had falling share prices. I think we're in for another probably rough 6, 7, 8, 9 months. And I don't know if we already have hit bottoms, but I think in the next 6 months we'll see bottoms in the share market, and the opportunity is not going to be so much in the commodity price itself, but it's going to be in the share market, potentially buying into things that benefit from higher commodity prices. But yeah, I still think that those kind of like very, very solid equities are going to do better for you in the shorter term. But then the time will come where once commodity prices have fallen, that you start moving towards rising commodity prices again. But I get the sense that we're getting towards the top of the cycle at the moment, and even we might even just be over the top of the cycle. So just be cautious. So now I'm going to have to give you some stock picks, because I think that's always tradition with the JSE Power Hours. So all these things. So I just wanted to put our research committee up here as well. I've drawn 2 of these from Anthony Clark, who's we're very fortunate to get some small cap input for him. So 2 of my stock picks are actually Anthony's stock picks. Of course, if you haven't signed up to our stuff, I mean, please go sign up to our weekly wrap. It's free for all. You don't have to be a client. And obviously, if you are looking at trading actively, if you want to go and trade, gold and silver and the kind of the shorter term price movements, we have a little service called Trader Connect, which kind of sends out little recommendations to things. And you will have to become a client, unfortunately, to get that. But the free for all, if you don't want to, you're not ready to be a client, at least come and listen to us once a week. Both give us his view of what's going on in the world, a little 10-minute video. So go sign up to that. But I'm going to kind of share some of Anthony's picks with you. So these are commodity based. Now I'm sticking mainly to the softs, not the hards, because I think some of the miners have already run hard enough. And the one that we like at the moment is Omnia. Omnia is, of course, first, it's kind of inputs into the agricultural sector as well as the mining industry. If you actually look at the revenue splits for them on 2021, it's just under half of their revenue is generated from agriculture, about 30% is generated from mining. So a nice input into the commodity markets. The rest is kind of made up with the chemicals business. But if you look at what's happened to wheat prices, corn prices, all those grain prices, with those kind of shooting up as they have shot up, farmers will demand. They are going to try and plant. The kind of prices they're willing to pay for things like fertilizer is going up dramatically. The fact is that, yes, there has been some adapting in the Russian and Ukrainian situation, but the idea, it was a question that was asked to me by a client today, what happens if the Ukraine war ends today? What will happen? And my kind of view is like, markets will probably pop 7%, but a lot of this has already been kind of worked into the market. But yeah, looking at it, I mean, there's certainly still a tailwind in this. And looking at Omnia, I mean, Omnia has been a fantastic provider. And again, you've got a really top-notch management team in there. And currently the target price, I mean, the stock, I checked the stock now, stock is trading, it was trading at around 72 at close today. Anthony's target on this is 100 Rand a share. He says, a little bit of volatility after the results, but kind of he's quite comfortable to hold until 100 Rand a share. The second one is obviously Carp Agri. So Carp Agri, is if you're not sure what Carp Agri, it's kind of a company that it has a lot of inputs into the farming sector. It does everything from kind of like mechanization and all the. I mean, they've got like a fuel business in there. And it's trading kind of 40 Rand a share now. This is weirdly, Anthony says, one of the only companies that he would never sell in his portfolio. He's got it in his long-term retirement portfolio, if you want to put it that way. He thinks it's like incredible. I mean, he's been recommending it from 23 Rand, I think, and it's kind of achieved his price targets. I think that the reason the stock's been under a little bit of pressure recently, it was unbundled from Zero, so a lot of people received Carp Agri shares in their portfolio. They kind of probably were selling out of it because they didn't understand what it was. And there was like a little bit of an overhang on the stock, but certainly a good quality company that will definitely benefit if soft commodity prices remain high for the next 6, 12, 18 months. I think you can expect good results out of them. And then I think, so those are my kind of 2 stock picks that we'll come back in a year's time and you guys will be like, wow, Gary, those were terrible stock picks, or that would be great. And Omnia would be at 150 Rand a share. And I'll say, yeah, there you go. Anthony's a clever guy. But yeah, I thought I'll give you one kind of alternative idea as well that comes off our wealth desk, which isn't actually a stock pick at all. So this is actually a fund. So this is like if you want to try and take, instead of trying to understand commodity markets and try and scalp the 2% here and 3% here because you're actively trading an underlying commodity price. This fund, what this fund does, it is an offshore fund, but they're an absolute return commodity hedge fund. And they're basically trying to extract cyclical and structural anomalies from the agricultural commodity market. So these guys are traders. They are hardcore traders. I think there's about 6 billion Rand in the fund at the moment. It is quite difficult to get a custody and to get involved, but if you are interested, just drop us a line. But they've been around since kind of mid-2010, and the performance stats are up there for you. I mean, they've done exceptionally well. They're a hedge fund though, so just bear in mind that it is for kind of qualified investors. Minimum amount is going to be at least $100,000 to get in. Redemption is 30 days. There's not huge liquidity on it. Their fees are high. They hedge fund. They take 2% and 20% outperformance, but all of those returns are after cost. I mean, you can see with the chaos that we saw in commodity markets in 2020, I mean, they managed to make a 62% return that year, and that's kind of the MSCI World Index versus what their returns have been over the last 10 years. It does have an ISIN. It's a formally registered fund. Like I said, it's got about 6 billion Rand in it, if I'm not mistaken, and they've had a very, very solid performance. So if you're interested in something like that, where you giving it to a manager to run, that's definitely something that I think is worth having a look at. If you are interested in getting started with, not necessarily on the Polestar fund, but if you would like to get involved in, I suppose, trading and stockbroking and the JSE and markets, really simple to open an account with us. Come join the #1 securities broker in South Africa. Go to randswiss.com, open an account, send us basic FICA documents, ID, proof of residential address, proof of bank account, fund your account, get your welcome pack, and away you go. And that's it. I think I have 3 minutes to spare for questions. Sorry, Simon.
Hey, Gary, that was perfect. I've got my camera. You can barely, I'm in candlelight here. And it's the best I can do is a couple of candles. One day I must tell you folks my story of trading softs on Safex. First there was the limit up, then there was the half day, and it ended with me being delivered a contract. Let's be clear, a contract is 100 tons of maize. It was a horror story of note. A bunch of questions are coming through, many being answered. A quick last one, because I'm cognizant of time. Of the PGM miners in South Africa, have you got a preference? We've got Sibanye, there's Northam, of course, as well. There's Implats, there's Anglo Platinum. Do you have a preference amongst that group?
We do, we do. So we do run a local fund. Well, it's a local managed portfolio, discretionary portfolio for clients, and we have had we have Amplats in there currently, and we have Sibanye at the moment. Sibanye has obviously gone through a little bit of a challenging time with a very long strike, and obviously they have some issues overseas as well. So it's between Sibanye and Amplats. If I had to pick one, Implats, London, Northam, I don't think they're quite at the same grade. Sibanye, I think I do believe is a better management team, but Amplats is the juggernaut in the space.
Yeah, they absolutely is the juggernaut. Question came through around oil, and I think, Gary, to a degree, you've kind of answered it. Someone's saying, I bought Sasol in 2020, which, I mean, that means somewhere, what, 40, 50, I mean, maybe 80 Rand or something like that. Worth taking some profits on it. I mean, my sense from what you're saying here is, if not exiting the position, some profits up around the 400 is probably not a bad idea, because you're sitting on a heck of a profit over what, 2 years.
Yeah, 100%. Just remember that, and like I said, like I wish I could tell where underlying commodity prices were going. I wouldn't be doing presentations for you guys. But
you'll be polishing your island.
Exactly. But looking at it, I mean, we hold Sasol in the portfolio at the moment as well. And yeah, I think it all comes down to your weighting. It comes down, it's so difficult to answer that question. I mean, people always ask that question: should I sell? Should I? How big is your position in your portfolio? What kind of exposure do you have? You are sitting on a nice profit at the moment. I don't know whether Sasol's got another 20-30% to run. We haven't sold it out of portfolios yet, but certainly I think if you're sitting on a nice profit, these are very cyclical industries. Things can turn around very, very quickly, and you might be left regretting the fact that you didn't just take a little bit of the money off the table. So I would probably say sell out a little bit of the position, but that's again, when you're working with a portfolio manager, we would have to look at it in the context of your overall portfolio to see whether that is even a smart idea or not. But because it's always very difficult. Like the real, and this is what I just kind of want to maybe address in this question as well. The real skill of having a portfolio manager or managed portfolio is not necessarily just making super buy and sell calls. That's not what makes you a great portfolio manager. It's all the little extra things that you do. It's the little bit extra cost you get there. It's a little bit of an extra execution you get there. It's it's all the different aspects that go in. It's how does the correlation in your portfolio look to other things? There's a lot more that goes into portfolio management than just, I mean, hey, listen, great buy and sell calls also help.
Sure.
Let's not mince our words. But yeah, I would say, yeah, Sasol at this stage, lightening would probably be the right. I certainly wouldn't be adding Sasol to portfolios.
Yeah, and I take your point on that, Gary. And it's someone to hold your hand when markets are doing what they're doing so far this year. And if Sasol is your only commodity and it's a small position, that's fine. But if you've got Sasol and 19 other commodities and et cetera, and Sasol's 40%, it's a different answer. Which is to your point where the portfolio managers it. Folks, we have hit time. You're always welcome. You can find obviously randswiss.com. Gary is on Twitter. Gary Boyson. Rand Swiss is on Twitter. We'll take more questions there. I have been load shed, so this video is only going to go up sometime tomorrow morning. I'm going to go and try and find some dinner somewhere. Gary, always appreciate, always great insight, great presentations, and great timing. Hit it a spot on time. Thank you for your time. Ladies and gents, appreciate your time this evening. Everyone, stay safe. And if you're in cold parts of the country, which is probably everywhere except Durban, stay warm.